more on the latest Beige Book data, let's bring in former Fed Vice Chairman Alan Blinder. He's an economics professor at Princeton and the founder of the Center for Economic Policy Studies. Dr. Blinder, welcome to Bottom Line. Always a pleasure to have you on. We got the short recap from our economics editor, Michael McKee. What are your initial thoughts on this?
I don't think it contained any surprises. It's hard to believe anybody would be very surprised from that. You wouldn't expect much market reaction. We've got an economy that's weak, not catastrophic. We lived through a catastrophic economy. We know what that means.
Now, you've reviewed some of the details. Ben Willis was telling my colleague Matt Miller, less bad. That seems to have been the mantra for most of 2011. Is that what we can take away from this?
Well, actually, I think the mantra for most of 2011 was more bad. It was looking worse and worse and worse. In the last few weeks, the data have taken a little bit of an upturn. Not a lot to get excited about, but it's sure better to see it looking better than looking worse.
We did see, at least from what Michael was telling us, a key quote here: overall economic activity continued to expand in September, although many districts described the pace of growth as modest or slight, and contacts general noted weaker or less certain outlooks for business conditions. We've been hearing throughout the course of the year how businesses are going to have to drive this economic recovery because right now we don't have a consumer-led recovery.
Right.
When you hear comments like this, what do you think?
I think it's the story we've been hearing. It's not a big change from before. And it is true that, although a lot of people don't know this, the strongest component of spending has been business spending on equipment and software. Not on construction, although that's starting finally to show a little sign of life. That's been dead, as you know.
Yeah.
But business equipment spending has been quite strong, the strongest component of GDP by far.
And we did see at least those consumer price numbers came out today. Does that bode well for the economy going forward?
You know, I scratch my head about that. I think it doesn't.
Actually, you're not the only person to tell us that today.
I think it doesn't, in the sense that the way core inflation, it's not so much headline inflation, which is dominated by oil, but the way core inflation has been behaving has to make people on the Fed think about a potential inflation problem. Even the doves that tend to ignore it, the hawks, of course, dote on it. And this kind of data, with core inflation now rising, and finally getting to 2%, just gives greater weight to the arguments of the hawks that have been opposing Ben Bernanke.
Dr. Blinder, you were talking just a moment ago about construction, and that dovetails into housing because housing does continue to be a problem.
Yes.
And you can see that tangential evidence that with housing and with construction, the numbers of construction workers who are unemployed at this moment, it's a staggering amount.
Yep.
This housing problem, how long is this going to be with us?
Oh, man, I wish I knew the answer to that. I think for a while. If you'd asked me this question 3 years ago, I would have said it's gone by now.
Really?
I'd have been dead wrong. Yeah.
Why 3 years ago would you have said that the housing problem would be gone by now?
Because the slump has been so deep that if you sort of do the math and say, how much did we overbuild during the boom and how much have we underbuilt during the slump, the underbuilding now exceeds the overbuilding by a lot. In a normal market, this would have been leading to a revival of construction. This market is dead, and I think the main reason is the constant waves of foreclosures, one after another, killing the market.
Talk to us about the wage pressures. The FOMC statement saying that they remain subdued, but we are still seeing a lot of Americans, those who are fortunate enough to have work, their wages are stagnant at this hour, and their discretionary income is not as such that they would go out and start spending on items, even though we are seeing a drop back in the price of food and fuel at this point.
Well, that's right, and that's what you expect in a weak labor market. You know, we're starting, and this is tragic, we're starting to get used to 9% unemployment. We should never, ever get used to 9% unemployment. 9% unemployment is terrible. It's a horrible work environment. As many people have pointed out, when you have 9% official unemployment, you have many other people not in the jobs they should be in, working short hours when they don't want to be, having dropped out of the labor force, and so on. It's just a terrible labor market, and it's very hard to get wage increments in a terrible labor market.
Dr. Blinder, you said getting used to 9% unemployment. That ties into the uncertainty that that unfortunately seems to have a stranglehold on this economy and on the global economy. Talk to me about that psychology. If people do believe that unemployment is going to stay at this rate for an extended period, to mimic some of the Fed's language, if it's going to stay at this rate for an extended period, what does that do to the psychology of the markets, and what does it do, perhaps more importantly, to the psychology of the business community if people don't feel that they can hire right now?
Yeah, well, I think it's very bad for the psychology of the business community. I think, and I've thought this for a long time, the biggest uncertainty hovering over the business community is the ability to sell product.
Yeah.
If businesses thought they could sell product, there's uncertainty about healthcare, there's uncertainty about China, there's uncertainty about Europe. They wouldn't be worrying about that so much if they could sell product. That is the overwhelming uncertainty. And to get that reduced, we need more demand. We need more spending in this society. For example, putting some of those construction workers to work on infrastructure problems would be a natural.
But that does involve spending, and
Yes,
that is part of President Obama's jobs plan. Is there political will, the political stomach, to say one of the ways we can put our people back to work is fixing up these crumbling roads and bridges, but how do we pay for it?
Yeah, it doesn't look like there's the political will to me. There is on some parties. President Obama would like to do it. Some of the Democrats in the Congress would like to do it. Very few of the Republicans in the Congress would like to do it. And the prospects for getting something like that through are, I don't want to say zero, but pretty minimal.
Dr. Blinder, last 30 seconds. I wanted to get your thoughts on what we are hearing in the Republican presidential debate, where it seems that Fed Chairman Ben Bernanke and Fed policymakers seem to be in the crosshairs of a lot of the candidates.
Yeah.
What does that do to the legitimacy and the independence of the Fed?
Yeah, well, I think if it gets really bad, I don't think we're quite to that point yet, because none of these guys have gotten elected. And you don't hear so much of it from elected Republicans, though you have heard a little bit. But if it gets worse and it continues, you start potentially threatening the independence of the Fed and maybe scaring the Fed. The Fed doesn't scare easily.
Yeah.
The general rule of thumb is when you get political objections to what the Fed's doing, the Fed stiffens its back and says, I have to do it anyway. And I think that's where we are now. But there is a danger you can cross that line. And the crossing the line means a real threat of legislating against the Fed.
Yes.
And remember, it's just an ordinary law. It's not in the Constitution. Congress can change the Fed any day it wants in any way it wants.
Dr. Alan Blinder, Princeton University, joining us as we talk about the Beige book and all things related to the Federal Reserve. Dr. Blinder, thanks for coming in on a rainy day in New York.
Thank you.
Thank you, sir.